Welcome to my corner of the internet. I'm the house hacker, and today I want to talk to you about investing. And I want to kind of start this video talking about why it's important to invest. Then I want to cover some of the dangers with investing, and then finally I want to go over some of the techniques that I use in order to invest successfully. Okay, sorry, forgot to mention this is not financial advice. So now big FTC can leave me alone. But seriously, I'm going to include all of the research that I did below, all the sources in the description below. Go ahead and take a look for yourself. Do your own research and make your own decisions. So let's just dive right into the first part. With an average inflation rate between 2 and 3%, most other options, including interest from your bank account, will not be able to outcompete inflation, which means every single year you're going to be losing percentages of the amount of money that you own. So if it's sitting in a savings account that's giving you 0.1% interest and inflation is 3%, you're going to be missing out on 2.9% of the money that's in that account. It's just going to disappear. So it's always important to have that safety net, and then the rest of the money needs to be invested. The other reason why you should invest is it's so easy, a monkey can do it. And in fact, there are multiple studies where people actually tried to simulate this, and the monkeys performed surprisingly well. Like, for example, the Cass Business School in London went ahead and ran a computer simulation of a monkey investing 10 million times. So it's effectively 10 million different monkeys investing, and how they would compete with the market cap. And they actually outperformed the market cap 60% of the time. So that's a pretty solid number right there to pick from. There was also this Russian investor that got a circus monkey to invest by selecting 8 companies out of an option of 30, and that monkey supposedly outperformed 94% of the Russian investors that year. And finally, you have compounding interest. It is a huge force that you can use towards your financial success of constantly building on your wealth, and that is going to build your wealth faster than your income will grow. So it's in your best interest to leverage compounding interest, because every dollar now is worth several dollars in the future. And depending on how far in the future you go, the more it's going to be worth. Now I'd like to kind of get into the different dangers people run into and mistakes that they make. One of the biggest things I've seen is individuals wanting to try and beat the market. The way you beat the market isn't trying to outsmart it. The way you beat the market is through buying and holding. And so, when I was working in Afghanistan, I had a friend come and show me his investment portfolio. He was pretty proud of it. And the day he was showing me, he actually had great returns. But when I saw his long-term returns, it was substantially red. He was in the negatives on a lot of things. He was losing money. And it just shocked me, because his strategy clearly wasn't working. The buying and selling and trying to time the market, buy at the bottom, sell at the top, it just doesn't work. So in order for you to find a great deal of success, you've got to avoid that, because what will end up happening is you'll get emotional. You'll see your stock dropping, and by the time you sell, it's already too late. You didn't know ahead of time. There's no way to time it. And by the time that you see it rising back up again, you're going to buy in when it's too late. So try and keep emotions out of this and stick to principled rules like buying and holding. The other issue that I've seen people do is with the trading, one of the issues you run into is capital gains tax. Now I'm going to put a link in the description below that's going to kind of go over the different levels of capital gains tax depending on how much you make. And you're going to find that long-term capital gains is substantially better. Short-term capital gains has a maximum tax rate of 37%, while long-term capital gains has a max of 20%. That's a big difference. And then when you pair that with the fact that in 2020, the long-term capital gains, the first 40 was 0%. First 40,000 was 0%. And for most of everyone watching this, paying 20% is unlikely. You're going to probably be paying the 15%. So you really need to avoid the short-term capital gains, which means, again, buying and holding. So now let's talk about how I manage my money. And you can do your own research and use the information that I give you as like a starting point for you to do your own research and make your own decisions, because at the end of the day, it's your responsibility how you succeed with your finances. Diversification is key. And this part's really overwhelming, and I get it. There's so many companies and so many options, and how do you pick the right ones? And this part's really tough. Because when you look at how you diversify, right, we're going to try and break it down with, you have US markets, and then you have foreign markets, like, or the emerging markets, and then you have bonds. And then between those, you have the various sectors. And then you've got to diversify the sectors, because we're not done diversifying, by the size of the company, large, medium, and small. And when you start looking at those different categorization strategies that you need to diversify across, and we haven't even gotten into what your percentages should be depending on how aggressive you want to be versus how safe you want to play it, and things just get really difficult to wrap your head around. So what I recommend is sticking to ETFs. You could find yourself a good ETF that covers many sectors, that focuses on small cap, medium cap, and large cap investments. Then you can get yourself an ETF that covers emerging markets, and then you can buy a few bonds. Now here's the thing about the bond market, which is something that I started doing and I've noticed a lot of people recommending. I've started diversifying my bond percentages with cryptocurrency. So where originally the majority of my bonds were in bonds, almost no money now is in bonds, and a huge chunk of what I normally would have put in bonds is in crypto, and that's 5%. So I normally put 5% in bonds, and that's been totally transitioned almost entirely into crypto. And I think crypto's demonstrated that it's not just a market that's here temporarily. It looks like it's going to be here to stay, which is what's leading a lot of people to think that crypto is a good place to start storing. But with that said, you really need to be careful where you put it in with crypto, because there's a lot of those questionable cryptocurrencies that are coming out that are really worthless, but people are making them hoping to get some sucker to buy into it. Don't do it. If it's not a big, well-known one, the emerging ones where they're worth like less than a penny, I would be cautious around those. I'd also be cautious around anyone telling you they can time the market. I would also be cautious around anyone who's trying to convince you that they have some sort of secret. If they did, they wouldn't tell you. That's the truth. If someone knew how to make a ridiculous amount off of the stock market, they just wouldn't tell you. It wouldn't make sense, because then they would have one more person that could be squeezing money out that they could be doing themselves. So the best way forward is to just select ETFs. And if you think about it, right, if you just were to select an ETF for small cap, medium cap, and large cap, and then emerging markets, that's 4 ETFs. And you're thoroughly diversified. It's a simple process. You don't have to overthink it, and it will perform really well. And if once you get into investing and you think that you have a grasp on it, you can try and experiment with a small fund. But the easiest path forward is sticking to index funds or ETFs that are already diversified. So these are my insights on how to approach investing. To just kind of disclose it, that about 20% of my money is being managed by a personal finance advisor that is going to be manually managing that money. But it's only 20%. I'm curious to see how they perform compared to the strategy that I've been employing. And there's certain advantages they bring to the table, like tax loss harvesting and rebalancing, that I have been slacking on. So I'm curious to see what those additions to the investment strategy will do compared to my other investments. So if you like the video, please like and subscribe. Comment below and let me know what you think of my strategy and how it compares to yours in terms of long-term growth. Go ahead and share the video and see if we can get this in front of more eyes to hopefully help more people. And thank you for watching.